Hey everyone, welcome back to the Week in Charts, the show where I run through the most important charts and themes in markets and investing. Another huge show for you this week, a lot to talk about. We're going to run through the markets. We're going to talk about recent economic data. We're going to talk about the US consumer and some of the earnings reports that we have from Walmart and Target and Home Depot. And we're going to talk about the American worker and how levels of happiness are at the highest levels that we've seen in some time. So let's dig right in and start with this incredible comeback that we've seen in the equity market, but specifically the NASDAQ 100. Just a huge, enormous run off the October lows, 33% gains now for the NASDAQ 100 index, 13-month high, so highest since April 2022. And now we're only 15%, a little over 15% below the all-time high, which no one would have thought would have been possible. I think last October, we were sitting over 35% below the high. So if we look at 2023 so far, it's really been the complete inverse of 2022. So we often talk about mean reversion in markets, but this is really the extreme version of this. And you see this all the time in markets where the leaders become the laggards and the laggards become the leaders. But this is pretty extreme, even for the markets. We're seeing NASDAQ 100, which was by far the worst performing broad area of the market last year, down over 30%, leading everything this year up close to 27%. And then if we look at growth stocks, they really got crushed last year. They're outperforming this year. We got value stocks all the way down here. They really outperformed last year, now lagging. And if we look at within the S&P 500, we look at the mega caps, so the largest 100 stocks there, they were hit harder last year and are outperforming this year. So complete reversal across the board. If we look at the energy sector, I think this tells an important story as well. It was really the standout performer last year, up 64%, and this year down close to 9% year to date. So tech really got crushed last year, outperforming this year. Energy had one of its best years in history last year and underperforming this year. And we just have these broad trends where small caps, smaller companies are underperforming this year, and you have value stocks underperforming as well. So kind of a reversion to the reversion that we had seen for a decade before last year, where you had growth and tech and large caps outperforming. So if we look at the year-to-date returns and we dig into some of the names here, incredible returns. So NVIDIA leading all of the S&P 500 up 112% year-to-date. Just an incredible story. We'll talk about that a little bit more in terms of valuations in a little bit. But Facebook, right, really left for dead, has more than doubled on the year. AMD, strong year. Tesla, and then of course the big four: Amazon, Google, Apple, Microsoft, all up over 30% year to date. And you have the S&P lagging the NASDAQ 100, the Dow lagging both of those. And then down here at the bottom, you have small caps and regional banks, incredibly, right, down over 30%. And really, tech stocks are saying we could care less about regional banks. And really, the broad market's saying that as well for now. And so if we look at the percentages below all-time high, Apple sitting here only 3% below its prior all-time high. Pretty remarkable. NVIDIA only 5% below. Microsoft 6% below. Broad market 11%, which is less than what bonds are below their all-time high, which is 13%. You still have a number of tech stocks here down considerably from their all-time highs. But if you look at the biggest stocks in the market, Apple and Microsoft, almost there in terms of a full recovery. And if we look at those two holdings, the number one and number two holdings in the US markets, Apple and Microsoft, their weighting is now up to 14.1%. That's the largest we've seen with data going back to 1980 for any two companies. So Apple has the record in terms of its individual share, over 7% weighting just in Apple. And you look at the two combined, 14.1%. So pretty remarkable. Big are getting bigger, and the market's kind of rewarding large tech again. And why is the market come back in terms of the S&P 500 this year. There's many different stories that are being thrown around. Some people saying it's because the Fed is expected to be done hiking interest rates. Other people saying that the economy is doing better than people expected in terms of employment continues to grow. We don't yet see outright signs of a recession having already begun. But I think the biggest and simplest explanation is simply earnings. Coming back to that earnings story, and the market off of that October low was anticipating better earnings to come. And now with 93% of companies reported, you have S&P 500 earnings up 8% year over year. Nobody was predicting that heading into this quarter. They were expecting to be another down quarter for S&P 500 companies, and just much better than expected in terms of sales growth and earnings growth, going back earnings into positive territory. And if this doesn't always match up one for one, but over the past year, earnings up 8%, S&P 500's up a little over 8%. So in terms of where that leaves you in terms of valuation, not much changed from a year ago because you have earnings up 8%, market up 8%. But let's dig into that valuation picture and check out how tech valuations look versus historical measures, how overall market valuations look. And we'll start with the NASDAQ 100. This is a chart going back to 2009, and you could see that just incredible valuation expansion here. This was, of course, near the bear market lows in 2009. You had the median price to sales ratio of the NASDAQ 100 at 1.6 at the low. And you just had this tremendous period of growth, obviously, for all of these companies, but you also had this incredible period of multiple expansions, and that peaked in late 2021 at 8.5x in terms of the median price to sales ratio. Then we had last year where we saw just a collapse in the multiple, and most of that was due to simply the prices coming down for many of these tech companies, and the smaller tech companies got hit harder than the mega caps. So we saw those valuation multiples really come down, went down to as low as 4.2 last October. But with that huge rally higher since then, we've seen multiple expansion again. So we're up to now 5.4x. And the big question is, well, is that cheap? Is it expensive? And I guess the answer is compared to what, and what is going to happen with future sales growth, right? So if we compare it to, let's say, the past few years, it looks kind of average. But if we go back before that, still elevated in terms of valuation. What people were talking about in terms of interest rates and that being the complete driver of valuations, obviously you can throw that out. The Fed funds rate now is above 5%. And 10 years ago, Fed funds rate is 0, and you had a 3x multiple in terms of median price to sales. Now you're at over 5x, and Fed funds rate is above 5%. So there's not a one-for-one relationship between interest rates and valuations, not anything close to that. And if we look at the spread of price to earnings, price to sales within the large tech space, what we see is a lot of variation. So starting here with price to sales, NVIDIA 29 times sales, really standing alone in terms of that multiple versus everything else. But Microsoft still very high at over 11 times sales. Apple over 7 times sales, despite having negative sales growth over the last year. Tesla, we know that growth is slowing, but still pretty high growth for sales, but 7 times sales for an electric vehicle maker these days. That's a pretty high number. So you're seeing elevated valuations once again for the big tech companies, and S&P 500 as a whole is at 2.4 times sales, which is also above the historical averages. And if we switch over to earnings, we're seeing the two biggest companies, Apple and Microsoft, both at above 30 times earnings. So is the market simply saying earnings are going to boom from here, and therefore the forward valuations are actually cheap? Or is the market once again valuing these companies too richly? I think it's always impossible to say that. But if we look at NVIDIA, I'll make this case again here. I wrote about this in 2021 in terms of its price to sales. It exceeded the 2000 peak at the time and went above 30 times in terms of price to sales. And what I pointed out at the time is very few companies in history can grow into a multiple that high. The expectations were so incredibly high that it would be very difficult for Nvidia, let's say over the next 5 years, to grow into that through an increase in sales. And what we saw last year seemed to be confirmation of that. And we saw its price to sales ratio collapsed all the way down to 10 times sales. But since then, it's almost tripled again. And that's because the stock price has just exploded higher. Price to earnings also here, you're going back to 2000 levels. And what is the narrative behind this for not just Nvidia, but seems to be for the large cap tech space as a whole? Well, it's all about AI, and that seems to be what investors are betting on. Obviously, with Nvidia saying, and we talked about this, that they're just going to make windfall, enormous profits from the chips that they make that are used to power these AI systems. But they're really saying the ecosystem, the tech ecosystem as a whole, is going to benefit. So Google, obviously, with their AI product that they just announced a new upgrade to that's now freely available to everyone. Microsoft's obviously highly involved in it, but every tech company is now, if you listen to the recent earnings reports, talking about AI and how that's going to be a driver of future growth. But the question, of course, for markets always is, well, when is that going to growth going to come? How much is it going to be? And are investor expectations too optimistic? And that we can't answer. All we can say is that when multiples are this high, when you get up to almost 30 times sales, it's very difficult historically for a company to grow into that. So we'll revisit this in the years to come and see if Nvidia is the exception to that rule, really, where it's very difficult for an investor to be profitable when you get multiples up that high. But if we look at the last 5, 10, 15, and 20 years, this is like a chart that I like to put out from time to time just to illustrate a number of different things. That there's a variety of companies in the long run in all different sectors and industries that have done well in the US market. So there tends to be this hyper focus on the tech sector. That's what we know, that's what we use. But all different, if we look at the last 20 years, you can see companies in many different areas. You have things like Tractor Supply, you have Intuitive Surgical in the healthcare space. You have, of course, Apple, but you also have Monster Beverage, which outperformed everything. So the notion that there's only one sector that's going to lead to the biggest gains, that hasn't been true historically, not likely to be true going forward. But if we're looking at Nvidia here, it stands out in terms of the last 5 years, the last 10 years up here, best performer overall. The last 15 years, did Nvidia make it? Yes, number 3. And the last 20 years, there it is again, number 9. So it has a spot in all of those areas. Incredible growth, incredible story. Obviously, the product is not going away. Semiconductors are just becoming more and more important. The question is, are investors in the future going to see anything close to these types of gains? Probably not likely, given the current market value of Nvidia being now obviously in the hundreds of billions. And it's not a small company by any means at this point. So leaders of the future are not likely to be the leaders of the past. PayPal, one example of that. So not everything is seeing a multiple expansion this year. PayPal, really the standout in terms of companies moving in the opposite direction, now down over 80% from its peak in 2021, hitting new multi-year lows here. And this is really a mean reversion valuation story. It was valued at almost 17 times sales at its peak here in 2021, and now down to around 2.5 times sales. And is 2.5 times sales, is that enough? It's close to pretty much the S&P 500 sales. Well, that depends on expectations for future growth. And what the expectations are today is they're coming down every single day. So this type of story is much more common than seeing these type of gains. And that's why picking individual stocks is a very difficult game. There's many more PayPals out there than there are Nvidias or Teslas. So If we look at the S&P 500 overall and we look at its valuation, what I like to look at most closely is the CAPE ratio, which is simply smoothing earnings over a 10-year period. So not just looking at 1 year's worth of earnings, which can be very volatile, but looking at 10 years and adjusting that cyclically for inflation as well. And what we see here is the multiple is down from where it was certainly in 2021 at its peak, but still well above its historical average. And the point by looking at this chart tells you nothing about the short term. So we should not be surprised if this CAPE ratio goes back up or goes lower from here over the next year. No one can predict that. The only thing that this kind of tells you historically is when you've been at the extreme. So up here, in terms of high valuations, or down here in terms of low valuations, historically, when you've seen those extremes in either direction, you tend to see worse returns after very high valuations and better returns after very low valuations. So what one might say is that over the next 10 years, still we're looking at S&P 500 returns that are likely going to be lower than their historical average. But that's, again, looking out long term. That's assuming that earnings aren't going to grow more than average. They're going to grow at the historical rate of return. And it also assumes, importantly, that this valuation level is going to mean revert. It doesn't have to come down to its historical average, but it's going to be lower, let's say 10 years from now, than it is today. Because if valuations simply stayed the same, well, then you don't have that multiple compression pushing down that rate of return. So just interesting to see here. Not nearly as extreme as we were in 2021, but after that sell-off, and now we've had a 20% rally in the S&P 500, this is where we are today. You can't really say that we're very extreme in terms of the expensive level, and you certainly can't say that stocks are cheap. So let's discuss the U.S. consumer. This is, to me, by far the most important factor to watch in terms of the overall U.S. economy, because the consumer is by far the biggest driver of economic growth in the U.S. So what's been the big story over the last 2 years? Well, it's been this chart, and you've seen me talk about this many times. It's the fact that U.S. wages are not keeping pace with inflation for 25 consecutive months. And what we talked about all of last year is how this was likely to drive a decline at some point in consumer spending. And it took some time before really that behavior changed. But over the last 6 months, we've been saying that that behavior really has changed. And if we look at consumer sentiment, it was kind of portending this all of last year. We saw the lowest reading in history for this University of Michigan Consumer Sentiment Index, and it kind of stayed low for most of the year. Popped back up early this year, but now has come back down to levels which in the past we've seen only really in recessions, with the exception of this brief period in 2011. So U.S. consumer, not really very positive, and that tends to be associated with lower levels of consumer spending. We didn't really see that last year, but now we're finally seeing it. If you look at the retail sales data, we now have the lowest year-over-year change in nominal retail sales since May 2020. So obviously not anywhere near the type of declines we saw there or what we saw in 2008 and 2009, but we're heading in this direction of just simply slower growth. And remember, this is a nominal number, so inflation over the last year is at 5%. And so when you adjust for inflation, this is turning negative. And this is really the much more important story, given that inflation rates have been so high. You have to adjust for inflation, because as we'll talk about in a little bit with Walmart in terms of their sales and earnings, you have this situation where if simply they sell the same number of goods, they're going to have a higher dollar amount of sales because of that inflation, because the prices are higher. So when you adjust for this inflation factor, we have negative year-over-year retail sales for now 6 months in a row, lowest level since April 2020. And you can see here, during recessions, at least in 2001, 2008, 2009, 2020, obviously very briefly, due to the stimulus measures, you see this negative year-over-year inflation-adjusted retail sales, and that's what we're seeing today. So this is, to me, by far most important factor kind of portending maybe not this month, maybe not next month, but saying if this behavior continues, this is what's going to drive the US economy into a recession. So, what's the factor that we talked about last year that was likely at a point where it couldn't go much lower, and what people were doing to maintain their level of spending? So all of last year, said, well, how is the U.S. consumer still spending money? How are they still increasing their spending if their earnings are not keeping up with inflation for this long period of time? And what we said was there's two factors that were driving it. One is that consumers were saving less. So we saw last year the lowest savings rates since 2005, 2.7%. And what we said at the time is that when they change that behavior, when they start to say, well, I can't really save any less, or I shouldn't save any less. And what if there's a recession and I lose my job? Well, then maybe I should start saving more to prepare for that. And so far this year, that's what we've seen. So the savings rate has gone up. So if the savings rate goes up, that's less money that people are spending. But the second factor that was enabling people to maintain their spending last year was an increase in borrowing. And that hasn't changed, it doesn't seem, just yet. We still see, so we have new data on credit card balances for the first quarter, just another enormous increase here, now up 17% year over year. That's the biggest increase that we've seen on an annual basis since 2001. So consumers have a choice, at least in the short run, to say, should I spend less or should I save less and borrow more? That combination last year really slowed the decline in retail sales. We're finally seeing the consumer savings rate go up, but in terms of credit card balances, we're still seeing that go up. So you close that gap in terms of wages and inflation by borrowing more. At least that's what they're doing in the short run. I don't think this can go or will go too much higher from here before people start making that same calculation, or before banks, as we'll talk about in a little bit, start tightening their lending standards, and they won't issue that new credit, or they'll cut the amount of credit that they're issuing. So I think we're getting closer to an extreme here. And why this is becoming problematic in terms of taking on new credit card debt, we've talked about it, but just we have to really talk about it again here because it's so glaring here. Credit card interest rates above 20%. So if you're carrying a balance on your credit card, try to pay that balance off now more important than ever at 20% interest rates. And the increase in debt just compounds that problem. So you have more debt at a higher interest rate. Well, now it's a higher minimum payment that you'll need to make, and ultimately higher interest payments going forward, unless you can pay that balance off. So at a certain point, this will hit an extreme where it starts to crowd out spending. So people are spending more on the interest rate of their debt, and they're not spending as much on consumer goods. And I think that we're getting closer to that happening. It could be happening already. If we look at places like Home Depot, we're definitely seeing a very different picture than what we saw just a year ago. So Home Depot revenues came in down 4% year over year, biggest decline that we've seen in over a decade. We have net income here down 8%, with the exception of that dip in 2020. It's the biggest declines we've seen in net income for Home Depot in a long time. So what's driving this change at Home Depot? Well, it's a number of factors. Number one, retail sales and spending, as we talked about, has slowed. Number two, Home Depot's tied to the housing market. And as we talked about, and we'll provide additional evidence of that, housing market's been in a recession for over a year now, and people are spending less money on their homes. They're doing smaller amounts of in terms of projects. So there's been a shift from larger projects into smaller ones. This was what they talked about on the Home Depot earnings call. And they're buying fewer discretionary items. So things like new appliances, or purchasing, or doing an upgrade in terms of flooring and kitchen, bath items, things that are not necessary today, but you would like to do, they're pushing that off, right? And perhaps we saw a lot of that demand being pulled forward. So remember, Home Depot was one of the biggest beneficiaries in terms of the what we saw in 2020 in terms of people staying at home more, in terms of getting that stimulus money. People were spending it on their home pretty much more than anywhere else. So in terms of upgrades, in terms of buying new, if you're spending more time at home, you're going to want to make your home nicer. That's what people did. They spent just a ton of money at Home Depot. We talked about the lumber impact in terms of skyrocketing price there on the way up, and that helping revenues. And now it's having the opposite effect. I think they mentioned it on the call in terms of lumber prices have really collapsed, and we'll talk about that in the earnings section. So we had two other big retailers report, Target and Walmart. Target, pretty similar to Home Depot. You saw a big slowdown, barely positive in terms of revenue growth year over year. And what they said was consumers under pressure. You got this consistent inflation picture that we've talked about. They're running out of savings, and that might be that chart that we showed in terms of savings rates are going up. If you're running out of savings, what do? You're probably going to try to save a little bit more for an emergency or other things. And consumers are making trade-offs. So they're buying less discretionary stuff and buying more staple stuff. So Target mentioned that. Walmart as well. Big shift towards groceries and essentials. Walmart's positioned well for that. 60% of their sales come from groceries. So Walmart stock actually rallied on that news, had pretty good overall revenue growth. But if you dig in and see where that growth was coming from, they had low double digits growth in food and consumables, whereas general merchandise is declining mid-single digits. So Walmart showed that in terms of an inflationary trend for a business, Walmart actually benefited because people are more concerned about what they're spending. They're going to try to find a cheaper price for everything. Walmart's known as the lowest cost consumer, but groceries in particular, because the cost of food at home has gone up so much over the past few years, no doubt more people are shopping at Walmart for their groceries, and so they saw a bump in their sales. And just simply, as we talked about, it's very hard to cut back on the amount of food that you're buying. That's going to be the last thing that you're cutting. And even if you're buying the same quantity of food as last year, with inflation up the way it's been over the last year, and still food price inflation was over 7% in that first quarter. So you're going to have a 7% increase just from the increase in prices alone, even if you sell the same exact quantity as last year. So story in retail is U.S. consumer pulling back. Now let's talk about housing. And this is something we'll just touch on briefly because it's a continuation of the trend that we've been seeing, which is home prices very slowly coming down on a year-over-year basis, now down 1.7% year-over-year. If we look at existing home sales, the median price, that's the biggest year-over-year decline we've seen since 2012. And so the question is, well, are home prices now affordable? And the answer to that is not so much. If we look at the median mortgage payment needed to afford the median asking price home, so homes that are currently for sale, you look at the median price home for sale and you calculate the monthly mortgage payment needed to buy that home, you're at a record high. So even with mortgage rates where they are today, around 6.4%, you're at a record high in terms of that payment, so which is higher than last year, obviously significantly higher than 2021 and 2020. And if we look at that differential, just 3-year period, you have the mortgage rate more than doubling. You have the U.S. home price in terms of new homes going up significantly. That's leading to a much bigger number in terms of what you need for a down payment, and a much bigger number in terms of the what that monthly mortgage payment is going to be. So still very much unaffordable. And because we have the situation where more than 2/3 of mortgages are below 4%, we're seeing really this collapse in housing activity. People simply can't afford to move, even if they wanted to. So what you're hearing many people say is they're looking at their price of their home, and perhaps they bought it 5 years ago, and they're saying, gosh, the home is up 50, 60, 70%. Some places doubled in that period of time, the last 5 years, but my income's not up that much. And now with the mortgage rate going up the way it has, that person, that household can't afford the home they're living in if they had to buy it today. So what that's leading to is just a really collapse in the level of inventory. At the same time, you're seeing much slower rates of housing starts. So they're just simply the building that's really being priced in terms of looking at home builder stocks hasn't really started just yet. We're seeing a 22% year over year decline in terms of housing starts. That's the 12th consecutive year over year decline. Maybe it's bottoming here. We're hearing a lot of home builders saying more positive things in terms of demand there, in terms of they're just a bigger percentage of the homes that for sale are new homes. But the combination of this factor that you have fewer homes being built and you have people that can't afford to move because they have mortgage rates that are much lower than current rates, and home prices have gone up so much, is leading to just still very low inventory levels. And if we look at transactions, so existing home sales, simply the number of transactions, they're now at 20 consecutive year-over-year declines, down 23% year-over-year. That's the most consecutive declines we've seen since 2007, 2009. So prices slowly coming down, but not fast enough to really change that affordability picture. And just touching briefly on this housing market index, which is a measure of home builder confidence, it bottomed last December here, lowest levels we saw since 2020. And now we're back to 50, which is kind of like a break even level in terms of confidence, where above 50, you're going to have more builders saying conditions are good rather than poor. So home builder confidence is going up. Why are they more confident? Well, it's because if you listen to the commentary there, 33% of homes that are on the market are new homes. And so they're having an easier time selling that home because there's just so few existing homes on the market. So there's if you're in the housing market, in the market to buy a new home, you're increasingly likely to buy a new home versus an existing home. Whereas the historical average, I think over the last 2 decades, is only 13% in terms of what new homes make up as a percentage of existing homes for sale. So let's touch base on the recession. And this is just a slow motion kind of train that has been just slowly moving in one direction. If we're looking at leading indicators every single month, this seems to get more into negative territory and more into levels where it's becoming harder and harder to make the case that we're not going to see some type of downturn in terms of economic activity. The one real notable exception in terms of the components of the leading indicators has been stock prices. So if we talked about housing, we talk about consumer stuff. If we're looking at anything like ISM, new orders, we look at consumer expectations, we look at the interest rate spread. So looking at the yield curve, that's obviously screaming recession. We're going to talk about credit in a bit, but everything with the exception pretty much of the stock market, which is also a leading indicator, of course, suggesting we're going to see a downturn in the economy. So is the stock market wrong, or are these other indicators wrong? We'll see in a few months, but this is an important one that is trending in the wrong direction. And so we got updated data here in terms of the net percentage of banks that are tightening their lending standards. We're up to 46%. As you can see here, very difficult, becoming more difficult to make the case that this isn't going to cause a decrease in economic activity. So obviously banks are, if they're tightening their lending standards, you're going to have less loans available, and less loans available means companies buying less, spending less, and that's going to lead at some point to a slowdown in economic activity, most likely. So we'll watch this closely, and this obviously impacted by the recent banking failures. And that's an issue that hasn't totally gone away just yet. I mean, we're still, if we look at the regional banks, we've seen a little bit of stabilization over the past week, but nothing, not enough of an increase to say that there won't be another failure that might make this picture even worse before it gets better. And if we look at the money market mutual fund assets, we just see continued flows into money market mutual funds and out of banks in terms of deposits. Not as much as what we saw immediately after Silicon Valley Bank, but nevertheless, the flow is still moving in that direction, and that should put additional pressure on certain banks, most likely. And why is this happening? Two main reasons. One, you have that fear, obviously, if you're above the FDIC limit, a fear of your bank failing and you losing some of your money. But the bigger factor is just that banks are not competitive in terms of the deposit rates they're often offering versus these money market funds, which now have a yield above 5%. So consumers are voting with their feet. This is a trend. As long as the Fed isn't cutting rates, I would think that this trend is going to continue. Uh, once you see 5% rates persisting for a period of months, more people are going to be talking about it. If you're getting 0% on your money in a bank, and it's so easy to simply move it to one of these vehicles, I would think that you're going to see that continue. So either banks are going to have to be much more competitive in terms of what they're offering, and they have been raising their deposit rates, but not fast enough, or you're gonna just see this flow continue, and I suspect that's what we're going to see in the short run. So this is an interesting situation because in the S&P 500, if we look at what's happened in the last year, revenues have slowed down considerably, but not down in terms of being negative, but slowed down. And they cut spending enormously to the point where profits went up. So you saw, particularly in the tech space and big tech, those big layoffs, big cost-cutting initiatives, and that's led to improved profit margins this year. And we saw now S&P 500 profits actually go up 8% year over year despite a slowdown in revenue. So the U.S. government doing really the opposite. They saw tax receipts coming in. So this is a chart showing you federal tax receipts year over year percentage change. They were down 6% year over year in the latest numbers that we got. And what were they talking about as big drivers to that? Well, a lot of people are saying simply the capital gains that we saw in 2021 weren't there in 2022. So all of those big profits on crypto and tech stocks and from all of the gains that we saw in 2020 weren't there last year. And when people are filing their taxes for 2022 this April, well, instead of owing a lot of money because of big capital gains, they likely had capital losses. And of course, that's not creating revenue for the government. So we're seeing this decline in U.S. tax revenue, pretty sizable decline, as you can see historically. The last few times we had big declines. Well, you had very briefly in 2020, but that came right back. But before that, you had recessions. Obviously, here the 2008, 2009 recession, but before that in 2001. And obviously, in both of those situations, you also had big stock market decline. So we'll see if this continues, as it tends to be somewhat of a leading indicator in terms of the slowdown in tax revenue. A pretty sharp move lower here. So we'll see if that was just a one-off from the lack of capital gains, or this is something that persists. But interestingly, while tax receipts are down 6%, if you look at government spending, it was actually up 6% year over year. And what that's led to is a big increase in the deficit. So we're seeing an almost $2 trillion deficit in the US, just an enormous number for an economy that's supposedly still in an expansion. So one has to wonder, what is this number going to look like if we get to a recession where we have unemployment that's going up, we have job losses, and there's calls for additional stimulus? Are we going to see $3 trillion, $4 trillion deficits again? Is there going to be an appetite for that given what happened the last time? I'm not sure of the answer to that, but it's pretty interesting to see that the deficit is widening this much in what's supposed to be an expansion. And why the national debt is problematic, we get a reminder every single month. It's because you have to pay interest on that debt. And when interest rates are low, no one seems to care about that. But when interest rates are rising and each month that old debt at low interest rates is rolling off and new debt is issued at higher interest rates, especially on the short end of the curve, which is now above 5%. You're seeing a higher interest expense every single month. So this is going to be a front and center issue as we head into the 2024 elections, I think. Let's talk about the Fed very briefly here. So last video we were saying market was pricing in almost no probability of a hike at the June meeting. Now you have a little bump up in that, and we're seeing 6-month Treasury bill yields respond to that. 538 now in terms of the yield, highest since January 2001. And what's driving that really is a shift in expectations, where now the market's not pricing in a huge probability of a hike in June, but a little bit, right? So there's a little bit of an expectation, perhaps, that the Fed might hike again. If you listen to Powell, he gave a speech today, and it didn't seem like they had made a decision one way or another, and it didn't seem like he thought it was going to be 100% necessary. And as we talked about in the last video, there's just a number of signs that he's going to get in the next month before that inflation, before that FOMC meeting. He's going to have another inflation report that's likely to show a sharp decline in CPI, where the Fed should have plenty of room to pause at that point. Now, number of other Fed officials have been talking about how the risk is in stopping here, and that maybe another hike is necessary. So this is going to change, I think, a lot between now and the next meeting. But for now, there's a little bit of a chance of the Fed hiking, but I think it's just going to be dependent on the data and how the Fed is feeling. I think they have more than enough data at this point to say, let's just pause and see what happens. And they're going to get two huge inflation numbers in the next two months. Huge, by huge, I mean they're going to get two ones that show a sharp decline in the inflation rate. So I think it'll be really hard for them to say, gosh, inflation's coming down so rapidly in these reports, but we're still going to hike. I think it would be harder for them to make that case, especially if the banking problems are still going on. So what's getting better in terms of inflation rate? Almost everything is trending in the right direction here. So we got new data on import prices down almost 5% year over year. That's the biggest decline since May 2020. So complete opposite of what we were seeing just a little over a year ago, where this peaked at 13% year over year increase. Then we have producer prices just continuing the trend lower. Now we're down to 2%. And this has been leading in terms of the relationship with CPI. In this cycle, it's been leading. It doesn't always do that, but it's been leading. And a big part of that is just commodities have turned down pretty sharply. And so we would expect to see lower rates of CPI in the next few months. I think that's exactly what we'll see, but lowest here since January 2021. And I think there's a possibility in the next 2 months this could get close to zero or even go negative just because of the commodity picture. So if we look at rents, housing, of course, most important picture, most important component of CPI. And now we have Redfin data, 11 months in a row of slowing rent growth. So we're down to almost flat year over year in terms of what people are asking for their rents, likely to go negative, I think, in the next few months. A lot of things driving that. Big factors, you're seeing vacancy rates go up in terms of rent, and you're seeing more building in terms of multifamily units. So you're seeing more supply in terms of new apartments for rent. So that will likely drive this lower. And we'll see, as we talked about in the last CPI report, just finally starting to see that housing rate of inflation go slower. That was the first time that we saw that in a long time. So perhaps we're now going to see CPI do this type of decline, the housing component, following this with a lag. So I think we're at the point where we're likely to see slower housing inflation to come. And so this is a very good sign for the overall CPI and for the overall inflation picture. Then we have a leading indicator of food price inflation. Fertilizer continuing to move lower here, lowest since January 2021. Huge decline from the March 2020 peak. This is great news. You tend to see this lead in terms of food prices, lower levels there. We have lumber down now over 81% from its peak, just a huge collapse. Home Depot again mentioned this as one of the reasons why revenue was lower. People are buying lumber at lower prices. That's lower revenue for Home Depot. And if we look at corn and wheat, and that goes back to that fertilizer picture there, we have lowest levels we've seen. You have to go back to 2021 for both of these commodities. So very important here to see lower food prices. If we look at that food price inflation number from that CPI component, you could see last year it hit levels that we haven't seen. You have to go back to the 1970s to find food price inflation that high. So people are feeling this. This is food at home, so not eating out at restaurants, just simply going to the supermarket and buying food was more expensive in terms of inflation that we've seen since the 1970s. And thankfully, as we talked about, this has been coming down, and now we're down to 7% from I think it was over 13% last year at its peak. So 7% here, still very high, but I suspect just looking at corn and wheat, looking at fertilizer prices, we talked about eggs last week, they continue to move lower, looking at wholesale prices for eggs. So we're seeing a number of different food items see sharp declines. I think this is going to continue in the months to come, showing a lower rate of inflation for food. Very good news. So I want to end with a positive note in terms of workers. I think this was an unexpected poll that came out showing that workers are more satisfied in their jobs than pretty much they've ever been, with this conference board survey going back to the 1980s. Percentage of people that are happy at work is very high, and you can see it's been trending up before 2020, but really accelerated higher since then. And what's the driver? There was a few things that the survey mentioned, but the number one thing being flexibility. So more people are able to work from home or have a hybrid schedule, and that's very popular amongst workers. It's a perk that they got during the pandemic that they don't seem to be wanting to give back. If you look at all of the major cities, you're still seeing rates of office occupancy well below where it was before the pandemic. So as long as we have this situation where labor and employees have the upper hand, this is likely to continue simply because workers are happier. They seem to be pretty productive at home overall in terms of looking at how companies have done over the past few years. And so I think this is, if we're going to say there's any positive to come out of 2020, this would be the thing where people are happy having more flexibility in terms of when they do the work and where they do it. So very interesting to see that. One other thing that they mentioned in terms of this survey is that people left jobs that they weren't happy in and moved to other jobs. And if we talked about this quit rate going to up to 3%, which is the highest level that we've seen on record. So simply, people had more money in 2020 and 2021 because of the stimulus, because of the unemployment benefits that were paying a lot of people more money than when they were working. So they were able to quit jobs that they didn't like and transition into jobs that they like better. And of course, that will lead to people that are more satisfied in their jobs if they like their jobs. So good news there. Hopefully this stays up and this continues. I think obviously as this comes lower or back to normal, when the labor market normalizes, perhaps you won't see that level of flexibility. But overall, I'm hopeful that the American worker will retain some of these benefits they have, as long as it works for the company, works for them. They could find something going back to the old model where the worker wasn't happy and they're spending all of this time commuting and they're not very productive in the office. That doesn't seem to make much sense at all. So I think for a lot of companies, the hybrid model is likely here to stay because they're getting the most out of their employees when they're happier. So let's end it right there. Thanks everyone for joining me this week. Have a great weekend. If you like the content, subscribe to the channel, and I'll see you next time. Thanks.